Hey, are you ready to make some bullish moves? Let's talk about Peter Lynch. The man's a legend. He ran the Magellan Fund at Fidelity and turned it into one of the most successful mutual funds of all time. And you know what the best part is? His investment philosophy is something anyone can use, even if you don't have a fancy MBA from Harvard. Lynch's secret sauce? Invest in what you know. That's right, folks. You don't need to be a Wall Street wizard to pick winning stocks. Look around you. What products do you love? What businesses are killing it in your neighborhood? That's your starting point. You already have an edge over the pros because you see these companies in action every single day. This isn't about gambling on penny stocks or chasing the latest meme craze. This is about finding solid companies with real products and real growth potential. Companies you understand. So buckle up, because we're about to dive deep into Peter Lynch's playbook and show you how to unlock those Wall Street secrets. Booyah! Think about it. Let's say you love those new sneakers everyone's wearing. You see people lined up outside the store and you hear your friends raving about them. That's a sign. That's a company worth investigating. Or maybe you notice a local coffee shop that's always packed, while the big chains are struggling. That's another potential winner. See, as everyday consumers, we have a front row seat to the marketplace. We see what's hot, what's not, and what's gaining traction. Wall Street analysts, they're stuck in their ivory towers, looking at spreadsheets all day. They don't have that same connection to the consumer. You do. So use it to your advantage. All right, you've identified some promising companies. Now it's time to roll up your sleeves and do your homework. This is where the rubber meets the road, folks. Go beyond just liking their products. Dig into their financials. Read their annual reports. Understand their business model. What are their revenues? How much debt are they carrying? Are their profits growing? These are the questions that separate the amateurs from the serious investors. Remember, we're not throwing darts at a board here. We're looking for companies with strong fundamentals that can go the distance. Now, Lynch breaks down stocks into 6 different categories: slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. Don't let these fancy names scare you. They're just different ways to classify companies based on their growth potential. Slow growers are like that reliable old car. They're not going to win any races, but they'll get you where you need to go. Stalwarts are the blue-chip companies, the big dogs of the market. Fast growers are the up-and-comers, the ones with explosive potential. Cyclicals are tied to the economic cycle, like airlines or car manufacturers. Turnarounds are the companies that have been beaten down but are poised for a comeback. And asset plays? They have hidden value in their assets, like real estate or patents. Now, this is where it gets really exciting. Lynch talks about finding 10-baggers stocks that have the potential to increase tenfold in value. Imagine that, folks. You invest $10,000 and it turns into $100,000. That's the power of compounding returns. The key to finding 10-baggers is to look for companies with huge growth potential that are still under the radar. These are often smaller companies in industries that are just starting to take off. They might not be household names yet, but they have a secret sauce, a competitive advantage that's going to propel them to the top. Listen up, because this is important. One of the biggest mistakes investors make is listening to the market noise. The talking heads on TV, the doom and gloom headlines, the constant chatter about the Dow Jones going up or down a few points. Tune it out. Remember, we're not playing a short-term trading game here. We're in it for the long haul. Focus on the fundamentals of the companies you're invested in. Are their earnings growing? Are they gaining market share? Are they innovating and adapting to the changing world? If the answer is yes, then relax. Don't let the market noise shake you out of your winning positions. Earnings, earnings, earnings. That's what drives stock prices in the long run. It's not about hype or speculation. It's about cold, hard cash flow. When you're evaluating a company, always check their earnings growth rate. Is it consistent? Is it accelerating? And don't forget about the PE ratio, the price to earnings ratio. This tells you how much you're paying for every dollar of earnings. A high PE ratio might mean the stock is overvalued, while a low PE ratio could indicate a bargain. But remember, the PE ratio is just one piece of the puzzle. You also need to consider the company's growth rate, its debt levels, and its overall financial health. Selling can be tough, especially when you've seen a stock soar in value. But remember, even the best companies can stumble. So when do you sell? Lynch says you should sell when the company's story changes. Did their competitive advantage erode? Did their management team lose their way? Did their earnings growth start to slow down? These are all red flags that it might be time to take your profits and move on. And remember, there's no shame in taking profits. It's all part of the game. So there you have it, folks. Peter Lynch's secrets to unlocking Wall Street success. Remember, the person that turns over the most rocks wins the game. Don't be afraid to do your own research, to think differently, and to trust your instincts. Notice good companies in your everyday life. Understand their business, their products, and their competitive advantages. Buy their stock when the price is right and hold on patiently. Don't be swayed by market noise or short-term fluctuations. And finally, sell only when the company's story changes, not just because the stock market is having a bad day. Now go out there, find those 10 baggers, and start building your own Wall Street success story. Booyah!